Simeon, if I start with you, great record closes on Friday. Over the weekend, we've seen a little bit of lackluster data out of China. Do you expect that to weigh on the U.S. sentiment? Because last week seems to shrug off any of the challenges that the markets throw at them.
Such a weakness in China, although the retail number, industrial production, not too bad. So kind of mixed numbers there. I mean, look, it brought me a little more optimistic to see at least a little bit of steepening in the yield curve out of the Fed's comments. It's what you want to see. If the Fed cuts, you want to see the long end go up a little bit, because that's some indicia that maybe they're not pushing on a string. So I think with some decent economic data that we've seen, we're not going to get blockbuster earnings, but maybe we avoid that earnings recession and stocks hold up reasonably well.
Brian, those record closes justified in your opinion?
Yeah, the record closes are justified, and we're in an environment of modest growth, modest inflation, and generally easy accommodative policy, monetary policy. So that is a good backdrop for equities. The two primary underpinnings in this cycle has been a Fed that's backed off whenever they've tightened financial conditions, and Chinese policymakers who have come forward with some stimulus every time China has slowed. Neither of those two stories have changed, and that's what the markets are applauding.
Mm-hmm. Simeon, small caps haven't hit their own record of late. So what's your thoughts on that?
I think there's a real opportunity there. First, from a valuation standpoint, price to book, about 35% discount from large caps. But remember that small caps do tend to react quite well for Fed easing cycles. The challenge there is there's a lot of debt. 5 times net debt to EBITDA on average for the Russell 2000. So if we get a little bit of steepener, it might be a wise idea to sort of stay to the quality side of small caps with a little less leverage to sort of thread that needle.
Brian, with this central bank easing and coming into earnings season, how are you positioned? Is it continuing the rotation into defensives or still kind of playing the beta?
No, I think the time for defensives is past. So this is going to be, you want to be in the cyclicals as inflation expectations pick up, as the yield curve steepens some. You want to be in the cyclicals. And, it's going to continue to be those companies that can generate true growth in a slow growth environment globally that are going to be the outperformers. And that's going to exist until the depths of the next recession into the recovery.
So when you're talking about going into cyclicals, you're really talking about this sort of notion that technology, for instance, because it has idiosyncratic growth, could actually be a sort of defensive cyclical play, because you're looking for pockets of the market that are going to see growth no matter what goes on.
Right, that's right. And what you find, if you look at the past cycles, you usually don't see market leadership change meaningfully from the time you get from a flat yield curve to an inverted yield curve into a recession. I think that's far out. But if you look in the 90s, technology was the big winner through the cycle until the end. If you look in the mid-2000s, energy was the big winner through the cycle until the end. So we should not expect to see meaningful market leadership change now. The companies that have been the big winners are likely to continue to be the big winners.
Simeon, in terms of retail stocks, Prime Day, of course, what's your view on the split between online and offline?
Yeah, big event sort of reminding us to take a look. If you look at the last e-commerce report, you'll see a couple of things. One that won't surprise people: online sales growing at 5 times the rate of the overall retail environment. However, the thing that might surprise people is how early we are in this transition. Only 10% of U.S. sales are online. So there's a long way to go in the continued disruption of the brick and mortar folks to the advantage of the online players. Just look at Walmart's struggles. They grow the online side so fast, and yet they're not making money on it.
But Walmart's doing well as a stock.
You can get some sort of dead cat bounce, but over the long term, the margins that are online as the legacy players grow their online businesses are just smaller than they've enjoyed.
So Walmart's rise this year is a dead cat bounce in your view?
I think it is. I think you saw the challenge with the chief revenue officer and the move there. So I think you see some real challenges that even though they're transitioning these businesses, the margins just aren't there. And you have to have almost double the distribution capability to both support the brick and mortar business and distributing right to people's homes.
Would you say the same for a Costco, which largely doesn't have much of an online business and operates much more at the brick and mortar level?
You have to have a differentiator, and of course the differentiator in the Costco is those surprises. You go in there and you find something you didn't expect, something that has to draw you in to the store, something unique.
Brian, banks start their reports today. Are you positive on that sector here in the US?
Well, so the steepening yield curve will certainly help. I mean, the banks were facing the challenges of what I would deem a policy mistake by the Federal Reserve last year. So we still had the lagged effects of that and the flattening yield curve. So I wouldn't expect to see robust earnings out of the financial sector, but conditions are certainly improving. So Fed backing off, easier financial conditions, dollar stabilizing, a bit of a steepening the yield curve, all supportive, all helpful.
To follow up on the notion that market leadership doesn't really change in a cycle, does that mean the laggards stay the same? And is it during the whole period, or should we look, for instance, this year, healthcare is the laggard? Will healthcare continue to underperform?
Yeah, I mean, the laggards over the part of the cycle. So what we've seen from the laggards, things like utilities, things like staples, those are going to continue to be the laggards. The deeper value parts of this market will continue to be the laggards because the value parts of the market need a catalyst. So, you know, at different points in this cycle, investors have said, well, that catalyst will be the Trump stimulus, and that lasted for a very short period of time. Or then more recently, the catalyst is going to be a deep contraction in economic activity and perhaps a recession, and that lasted for a brief period of time. But then investors always go back into this environment where we're not getting to new, higher, sustainable level of growth. We're not going into a recession. We're kind of in this 2% growth environment that hasn't been great for the politicians, but it's been really good for the shareholders, and that's likely to persist.